Asset. This is anything of value that you own or control which can be converted into cash. It matters because your total assets determine your overall financial strength and net worth. Think of an asset like a fruit-bearing tree in your backyard. It is a physical possession that belongs to you, and it has the potential to provide you with ongoing value over time. Common real-world examples include the money sitting in your savings account, shares of stock, or a house that you own. Bond, an investment where you lend your money to a government or a corporation for a set period of time. In return, they promise to pay you regular payments for letting them borrow your money and give your original cash back on a specific date. Imagine a big gaming company wants to build a new studio, so they issue a bond. You give them $1,000. Then they agree to pay you a 5% interest every year. This bond is locked in for 10 years. Now, every year for 10 years, the company automatically drops $50 in cash straight into your account, and you don't have to sell anything to get this. At the end of year 10, the contract is complete, and the company gives you your original $1,000 back in full. Capital. This refers to the financial assets such as cash or machinery that a person or company uses to generate wealth or start a business. Think of capital as the seeds a farmer saves to plant next season's crop. Instead of consuming those seeds right now, you use them specifically to grow a much larger harvest later on. Diversification. This is the strategy of spreading your investment money across many different financial assets instead of putting it all into one place. It lowers your risk, ensuring that if one investment fails, you do not lose everything. Imagine carrying a large supply of eggs in several small baskets instead of one giant bucket. If you accidentally drop one basket, most of your eggs will still survive completely intact. Equity. This is the value of your actual ownership in an asset after subtracting any debts or liabilities owed on it. Think of equity as the portion of a birthday cake that actually belongs to you after you have paid back the friend who loaned you the money to buy the ingredients. For instance, if your house is worth $300,000 and you owe $200,000 on the mortgage, your equity is $100,000. Fixed income. This is a type of investment that pays the investor a specific, predictable amount of cash on a regular schedule until it matures. It provides steady income with much lower risk than buying volatile stocks. You can compare fixed income to a reliable monthly allowance you receive for doing basic chores. No matter how wild the outside world gets, you know exactly how much cash will land in your pocket on the first day of the month. Gross income. This is the total amount of money you earn from your job or investments before any taxes or other deductions are taken. It matters because it serves as the starting point for calculating your taxes and determining how much money you can theoretically borrow. See, if your official salary contract says you earn $50,000, the government uses that full amount to calculate your taxes, and banks use it to decide if you are wealthy enough to safely handle a car or home loan. Hedge fund. Hedge funds are exclusive, high-fee clubs where ultra-wealthy people pool their money together so aggressive managers can use risky, complex, and financial gambling strategies to make massive profits, whether the stock market crashes or skyrockets. Imagine a hedge fund borrows a struggling company's stock, then immediately sells it for $30 million, waits for the company to crash, and then buys the stock back for only $10 million to pocket $20 million profit from the disaster. Interest, the cost of borrowing money or the reward for lending it, typically expressed as a percentage of the total amount borrowed or invested over a specific period of time. Think of interest as rent for money. If you borrow money, you pay the bank interest for the privilege of using their cash. In contrast, if you put money in a savings account, the bank pays you rent because they are borrowing your cash to fund their operations. Joint account. This is a bank or investment account that is shared equally between two or more individuals, typically married couples or business partners. It matters because it allows both people full access to the funds for shared expenses and financial goals. The downside to this is you also become legally responsible for any of their bad checks or overdraft fees, and creditors can come after the money if the other person goes into debt. For marriages, it basically means your financial trust is tested, since any spending or debt choices instantly affect you both. Kiddie Tax. This applies to kids under 19 and is a federal tax rule designed to stop parents from shifting their investments into their kids' names just to get a lower tax rate. Basically, once a child's unearned income goes over a certain limit, any amount above that stops being taxed at the child's rate and is instead taxed at the parent's higher income tax rate. The Kiddie Tax only targets unearned income like investments and interest. Any money a kid earns from a job like a summer gig is considered earned income and is strictly taxed at the child's own individual tax rate, no matter how much they make. Liability. This is basically anything you're legally or financially responsible for, like a debt, a loan, or a legal obligation. If you owe money or have a duty to pay for something, that's a liability. So it's the opposite of an asset, which is something you own that has value. It matters because having too many liabilities drags down your net worth and makes it difficult to secure loans. Mutual fund. A mutual fund is basically a giant pool of money collected from a bunch of different investors to buy a diversified mix of stocks, bonds, or other securities. Instead of you buying shares of just one company, a professional fund manager takes everyone's pooled cash and spreads it across dozens or hundreds of different companies, so you're instantly diversified without having to do all the heavy lifting yourself. Net worth. Net worth is basically the total value of everything you own minus everything you owe. Think of it as your financial snapshot. You add up all your assets like cash, investments, and property, and subtract all your liabilities like student loans, credit card debt, and mortgages. Whatever number is left over is your net worth, whether it's positive or negative. Opportunity cost. Opportunity cost is basically the value of the next best alternative you give up when you make a choice. Since you can't choose everything, every decision has a hidden cost, which is the benefit or profit you could have enjoyed if you had picked the other option. See, if you spend 2 hours studying for an upcoming exam, your opportunity cost might be the money you could have made working a shift, or just the sleep you missed out on. You didn't pay cash for it, but you still paid for your choice by sacrificing the other opportunity. Principal. Principal is basically the original amount of money you invest, lend, or borrow before any interest starts adding up. Depending on how you're using it, it means one of two things. When you borrow money like a loan, the principal is the exact amount you originally borrowed. When you invest or save money, the principal is the initial sum of cash you put into an account or buy an asset with which then grows over time as it earns interest or returns. So if you take out a $10,000 loan, your principal is $10,000 and any extra money you pay back on top of that is just the cost of borrowing it. Quick assets. Quick assets is the cash and other assets you own that can be turned into hard cash almost instantly, usually within 90 days or less. To count as a quick asset, it has to be super easy to spend or convert right now. Like cash, checking and savings accounts, and short-term investments like stocks or bonds you can sell today. So if an emergency happens tomorrow, your quick assets are the funds you can grab immediately to handle it. Roth IRA. A Roth IRA is basically a special type of individual retirement account where you pay taxes on the money now so you can withdraw it completely tax-free later in life. With a traditional retirement account, you get a tax break today but have to pay income tax when you pull the money out in retirement. Stocks. A stock is a tiny piece of ownership in a company. When you buy a share of stock, you are quite literally becoming a part owner or shareholder of that business. If the company does well, your shares become more valuable. If the company struggles, their value drops. You generally make money in two ways: capital gains, which means buying a stock at a lower price and selling it later at a higher price, and dividends. Some companies regularly distribute a portion of their profits directly back to shareholders as a cash payment, usually a few times a year. Treasury Bond. A Treasury Bond is basically a loan you give to the government. When the government needs to raise money to fund things like infrastructure, the military, or national projects, they issue these bonds to investors. In exchange for your cash, the government promises to pay you a fixed rate of interest every 6 months and then give you your original investment back in full when the bond matures. Unsecured loan. An unsecured loan is a loan that is approved without requiring any collateral. Collateral is a valuable asset like a house or a car that a lender can seize if you fail to pay them back. Because there is no asset backing the debt, the lender is taking on more risk, relying entirely on your promise to pay them back and your financial trustworthiness. Value-added tax. Value-added tax, which also means VAT, is a consumption tax that's added to a product at every step of its creation, but it's ultimately paid for by the final shopper. Everyone pays value-added tax, including students, because the tax is already baked right into the price of the things you buy at the store. Whenever you buy a snack, a coffee, or school supplies, you are paying that tax automatically at the register, regardless of whether you have an income or not. Withholding. Withholding is when a portion of your paycheck or income is automatically taken out and sent straight to the government to cover your taxes before you even see the money. Instead of leaving you to pay one massive tax bill at the end of the year, the government collects your income taxes bit by bit from every single paycheck you earn. Xenocurrency. Xenocurrency is basically any currency that is circulating or traded in a country outside of its own home nation. The prefix xeno means foreign, so it literally translates to foreign currency. If a company in Japan deposits US dollars into a bank account in Tokyo to use for international trade, those specific US dollars are considered xenocurrency. Yield. This is basically the amount of cash income an asset generates for you over a year expressed as a percentage of its price. Think of yield as the fruit a tree produces every year. If you buy a $100 apple tree and it gives you $5 worth of apples each season, your tree has a 5% annual yield. Zero coupon bond. A zero coupon bond is a bond that doesn't pay interest at regular intervals while you hold it. Instead, it is sold at a deep discount and you make money all at once when the bond matures. It matters because it allows you to lock in a guaranteed profit for a future goal without worrying about reinvesting small interest checks.